Right, welcome to part 2 of lecture 15-B. So we just discussed the presentation of bonds payable on the balance sheet, just real quick and dirty discussion here about how it very much resembles property, plant, and equipment minus the associated accumulated amortization account. So same goes for bonds. We have bonds payable and then less discount on bonds payable or plus premium on bonds payable, and that's what would be represented. The net of that would be represented on, as the net, the carrying value of the bond itself. Okay, so we have now this amortization of the bond discount or premium to deal with, right? So we've set up our journal entry. We've established this premium on bonds payable, this discount on bonds payable, and if you recall, I'll draw another picture down here. Over the life of the bond, that's the maturity, right? So this is time along this axis. Premium, discount here. And over the life of the bond, it's gonna the carrying value, the price, has to gradually approach zero. And whether it's either going to be one of these two, right? Not both. But so if it's sold at a premium, it's going to go down to maturity value, and discount up to maturity value. Okay, so and we know this simply because the cause of the premium and the discount is the difference between the coupon rate and the market rate of interest at the time that the bond is purchased or sold. And as we get closer to the maturity value, the impact of those differences is going to be less and less, because there's going to be fewer and fewer interest payments that are going to be different amounts from what the bondholders would be expecting to receive based on the market rate. So the whole deal associated with this is then, okay, how do we, from an accounting perspective, reflect the fact that a bond sold at a discount gradually increases in value until it reaches the maturity amount? Likewise, a bond sold at a premium gradually decreases in value. And how does that work when we look at what we have set up here, which is we have this discount on bonds payable or premium on bonds payable account, which we know has to be equal to zero on the maturity date. So essentially what we're going to do is we're going to amortize that account over the life of the bond so that it gets down to zero when the bond matures. So there are two ways to do this now. And the most common way is also a fairly tricky and complex calculation, and that is known as the effective interest method. We are going to, that's that guy right there. We're going to talk about it. I'm going to show you what that looks like in the next lecture, but we're not going to actually do it. We are going to do the simpler, although almost never used anymore, straight line method. And I don't normally like showing you stuff that is not applicable or practical, but the point here is not to get you good at doing these calculations, because odds are pretty good, unless you become a specialized accountant, you're never going to do them, but just to understand the mechanics of how something like this works. The actual black magic that goes into establishing the pricing, if you really want to find out about that, you can go take a finance course or some advanced accounting and get into it. So we're going to do the straight line method just so you understand the overall process. Now, it is simpler, and as I said, the course will emphasize straight line only, and therefore, from an exam perspective, any calculations you're required to do would only be straight line. You should understand the gist of the effective interest method, but that's about it. So, how then does it actually work? Well, the key is, just like straight line amortization, it's the same amount every single period. So, based on our example here, if we have a discount of $20,000, right? So back here, that was a premium, but the discount was the same amount, right? We had a discount of $20,000 here. So let's say we have 5 periods left before the bond matures, right? And that's 5 6-month periods. So the bond matures in 2.5 years, just to be clear. So $20,000 divided by 5 periods is equal to $4,000 per period, right? So every time we make an interest payment, we're going to reduce the amount of the bond discount by $4,000. In other words, the carrying value of the bond is going to be adjusted upward by $4,000 every 6 months until on the last day when it matures, the discount amount hits zero. And so the journal entry for that, remember this all happens on the interest payment dates. So we know that the corporation is going to record some amount of interest expense. Interest expense. And we also know that it is definitely going to pay cash. And the cash amount is what is fixed based on the coupon rate, the rate that's printed on the bond. And that was, for this particular bond, what did we say? $1 million bond. Let's assume 6% interest again. So let's go $1 million at 6% at 6 months over 12. So the cash amount paid is going to be $30,000. That we know we can compute it, no big deal. But we also have to amortize this discount. And so the trick is, whenever you're amortizing the discount or the premium, if you can't remember in your head that, hey, it's a discount, so we got a debit or credit or blah, 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 go to the entry where it was set up. The discount was set up with a debit, right? So if we're going to make that get smaller, we have to do the opposite. So you go to this entry, debit. That means we need to credit every time we do an interest payment. So discount on bonds payable $4,000. And therefore the interest expense, the debit to interest expense, what's going to show up on the books of the corporation as interest expense for that 6-month period is the plug of $34,000. And that should make sense because remember, the bond was sold at a discount. In other words, the price of the bond had to come down so that over the life of the bondholder achieves the market rate of interest. And so this interest expense over the life of the bond reflects the market rate. Right? So the cash payment is fixed, but the actual market rate of interest and therefore the expense that the corporation records is reflective of the fact that there was a discount involved at the point or time of issue. Likewise, so to kind of conclude then, if you get the gist of this entry, the interest expense that the corporation records is the cash interest paid, which is printed on the bond, basically, based on the rate printed on the bond, plus the amount of the discount that's being amortized. All right. So same example, except now we're going up here for the bond sold at a premium. Right, $1 million bond sold at 1.2. So the entry to record that is going to be likewise always a debit to interest expense and a credit to cash, and the cash amount we worked out as being $30,000, right? So it's the same deal as the other bond, same bond. But now, remember, we got to come up with the amortization of the premium. And so the premium gets set up here as a credit. So to lower or reduce this premium, we know we have to debit. So we're going to debit premium on bonds payable. And so that then, as before, $20,000, 5 periods, no difference there. That's going to be $4,000, which means that the interest expense then is plugged at $26,000. Again, that is the plug. Okay? So that is how we go about recording the amortization of a premium. And again, the interest expense in this situation is the cash minus, not plus, minus the premium amortization. Right? So it was plus the discount amortization minus the premium amortization. Okay, let's do an example to help try to solidify this. Ogden Inc. issues $500,000 8% 10-year bond payable at a price of 90. Journalize following transactions, the issuance, and the payment semi-annual interest, and so on. Okay, so On the 1st of January 2010, we issue the bond for cash. It's sold at a price of 99, 0.9 times 500,000 means that they're getting cash of $450,000. It's sold at a discount. And the discount obviously is $50,000 since the bond's payable amount is the maturity value of $500,000. Okay, and so now the amortization of the interest, let's see, it's a 10-year bond. We're going to assume semi-annual interest payments. So 10-year bond, semi-annual, so there's 20 periods, and the discount is $50,000. So 50,000 divided by 20 periods is equal to $2,500 per period. And therefore, the interest on 1 July 2010 is going to be interest expense, and then the premium, discount. So discount, to reduce that, we're going to have to credit, right? So we're going to credit discount on bonds payable, and we worked out that it was going to be $2,500. And then we have cash, and cash is going to be 8% of the $500,000 bond, which would be $40,000 twice a year, so divide by 2, $20,000. And so the interest expense recorded then is $22,500. Okay, going the other way, a premium now. Solar Corporation issuing $400,000, 7% 10-year bond, blah, 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 at a price of $105, so premium. Again, issuance. Okay, so on the 1st of January 2010, debit cash, and it's at 105. 105 times 400,000 means that they collected $420,000 from the issue of the bonds. We can debit bonds payable, always for the maturity value, 400, which means then that the premium $20,000. Okay. So now, semi-annual interest payment and amortization of the bond premium on the 1st of July 2010. We have interest expense. And now the premium, let's see, we have $20,000. So $20,000, 10-year bond, semi-annual, so divided by 20 periods means that it's going to be $1,000 per period. So interest expense, don't know yet. Premium on bonds payable. $1,000 and a credit to cash, and cash is going to be for the interest, so that's going to be $400,000 at 7%, so that's 28 twice a year, divided by 2, 14,000. And so the interest expense, then we're going to plug that, and that is $13,000. Okay, so that is the journal entries associated using the straight line method associated with amortization of bond premium and discount. Now, adjusting entries. Okay, so one of the issues that we have here is that everything we've done thus far assumes that the year end also happens to fall on an interest payment date. Now, odds of that are actually pretty slim. So what happens is that we need to do an adjusting entry at the end of the year to properly get the right balances into our accounts. So remember now, actually we'll continue this in part 3.